I now hand the conference over to Mr. Gaurav Jogani from Axis Capital Limited. Thank you, and over to you, sir.
Thank you, Aisha. On behalf of Axis Capital, I would like to welcome you all to Shoppers Stop's Q4FY21 earnings conference call. From the management, we have with us today Mr. Venugopal Nair, Customer Care Associate and Managing Director and CEO, Mr. Karunakaran Mohana Sundaram, Customer Care Associate and Chief Financial Officer, Mr. Jay Prakash Maheshwari, Customer Care Associate, Vice President, Finance and Accounts. I would like to hand over the call to the management for their opening remarks, and then we can open it for the Q&A. Thank you, and over to you, sir.
Good afternoon, friends. I do hope that you and your loved ones are safe and keeping well in these exceptionally trying times. I'm painfully aware the last 2 months were the toughest for many. We wish a speedy recovery to those who are battling this virus. Immense gratitude to all the people who are standing up against the adversary and are fighting tirelessly to help keep others safe, especially our frontline heroes. I, on behalf of Shoppers Stop, would like to express our heartfelt condolences to those who have lost loved ones. I would also like to thank every member of Shoppers Stop, including the brand associates, for their relentless commitment and dedication in these difficult circumstances. Adversity, they say, is a true test of character, and I'm absolutely certain the country will come out stronger. Before I talk about performance, please note that our results, including quarterly and full year, press release and investor presentations, are available on our website. I hope you have had a chance to browse through the highlights of the performance. The agenda of today's call will be as follows. First, macro indicators and COVID. Second, our performance in Q4, followed by our performance on strategic pillars, and finally, the way forward for FY22 and Q1 in particular. Let me start with the macro indicators. It's more than a year since the outbreak of COVID-19 in India, but the pandemic is not over yet, as we all know. When I spoke to you last time, we imagined that we are being done with this crisis, but the crisis is surely not done with us. We had a total of less than 200,000 cases 4 months back, and we thought we had sight of the silver lining on the horizon with the vaccination drive. But we are faced once again with a resurgence of this virus. We had over 300,000 cases a day for many days in April and May, and the total cases exceeding 4 million. Once again, a ray of hope is that presently the cases are declining and have now fallen well below 300,000, and the recovery is greater than the number of cases infected in India. The government and other municipal authorities are rightfully resorting to micro-containments to restrict the spread of the virus. As I speak to you, a large part of India is still in lockdown. Mobility is dipping in several cities as people confine themselves to their homes. There are uncertainties, and we have no control on some of these. We need to bring down the infection rate under control permanently for a meaningful recovery. A big silver lining during these critical times is the availability of the vaccine and the vaccination drive that has started across all the states. States and civic bodies are now directly procuring vaccines to ensure that our people are fully vaccinated. Central and state governments are working overtime to have production increased, besides supplementing these with imports. I'm sure each and every one of you, including your family members, would get vaccinated as soon as possible. I'm confident the Indian economy will come out better post the crisis, as the other indicators such as agricultural output, monsoon, demand of commodities, etc. are better than expectations. The central bank, in its recent policy, has incentivized banks to extend swift credit to important sectors, including small and medium enterprises. This will help the economy to recover, and we are confident from Q2 the momentum will start. Now I will turn on Shoppers Stop's performance for Q4. We had witnessed the highest sales recovery of 90% in Q4. We recorded sales of 825 crores. Our gross margin improved by 190 basis points. Our EBITDA profit of rupees 11 crores versus a loss of rupees 17 crores in FY20. Our footfall was 5% in Q1, 19% in Q2, 50% in Q3, and 83% in Q4 until the second wave of COVID impacted the footfall in the second half of March. As I said before, footfall has considerably improved in our non-metro stores. The East region outperformed other zones, recording growth. Our non-metro stores also performed exceptionally well. Incidentally, our non-metro stores grew 4% in Q4 as against a decline of 18% in metro cities. We continue to benefit from our customers' constant shift to omni-channel, choosing to engage with us both online and offline, including their preferences with the help of our personal shopper assistants. Our sales growth of 188% through digital channels gives us immense confidence in our continuing shift to become an omni-channel retailer. We observed significant improvement in our other KPIs too. Our customers have increased their shopping time with us. Consequently, the transaction size increased 6.2% for the quarter and 6.7% for the full year. Items per basket or per ticket increased by 14.6% and 15.2% for the full year. We observed better sales trajectory in a number of our product categories, including kids, denim, women's western wear, home, intimate apparel for both men and women, and even a moderate growth in formal wear. Now, let me talk about our strategic pillars, including omni-channel. Before I talk about every pillar, I am extremely glad to inform you that our performance has been exceptionally good in all our strategic pillars. We have been continuously exceeding our targets. As I've been saying in the last 2 quarters, the last 1 year has seen a paradigm shift in the way we operate. It has highlighted agility and resilience to reach our customers. A year before, many wouldn't have anticipated the role of omni-channel or e-commerce as it is today. Omni-channel has become the channel of choice for many customers. A strong focus on building a portfolio fit for this channel, building capabilities, and driving everyday great execution resulted in growing 188% or 3 times from this channel on a year-on-year basis. Our contribution, which was a mere circa 1.5%, has now consistently increased to 6% and above. We have been improving our customer interface and experience on our app and website, and we are satisfied with the progress that we are making over the last 12 months. As mentioned in the call from the previous quarter, we are the first Indian retail company to implement S/4HANA and currently implementing the retail and finance modules of S/4HANA in the second phase of this project. Our delivery turnaround time reduced to circa 3.8 days on e-commerce. Our customer satisfaction has been consistent at over 4.5. During the quarter, we have improved our fulfillment parameters by changing the allocation logic, leading to improved turnaround time and lower costs. Our goal is to have the best experience in Omni. We have introduced new brands exclusively for Omni during the quarter. Consequently, we have improved in almost every key parameter, such as customer eyeballs, orders, and transaction value. Our average transaction value is one of the highest in multi-category e-commerce, and we attract a premium customer base online, just like in our department stores. Our average daily traffic is in excess of 300,000. More importantly, our first citizen contribution in Omni has now reached 40%, and the repurchase frequency is now at 60%. In many of the parameters, we are ahead of most of the fully online companies. On the strategic pillar of beauty, I said last time we have mac.in, and now we have added Estee Lauder and Clinique in May. We have new beauty experiences with virtual makeup and virtual skin analyzer launched in February. Our sales performance in the marketplace via Amazon is consistent. All of these factors helped us to make a quantum jump on our e-com sales. Our e-com sales for the second consecutive quarter is in triple-digit growth, and for the quarter grew by 188% of last year, nearly 3 times. I'll now move on to our next strategic pillar of First Citizen. Our First Citizen sales continue to contribute bulk of our sales. For this quarter, our First Citizens contributed to 72% of our sales, as against 76% last year. The marginal dip is primarily due to COVID impacting the sales in Q4. We had new enrollments of 106,000, with average ticket size increasing 1% versus last year. In our annual subscription program, Black Card, which is a premium service, our enrollments increased by 172%, or 3 times over last year. Our sales to Black Card members increased by 117%, or doubled. Our store managers are personally assigned to Black Card members to further enhance this exclusive shopping experience on this annual subscription program of ours. On Omni, our contribution from First Citizen increased from mere 20% to 40%. On personal shoppers, our personal shoppers' contribution has been consistent even during these critical times. They contributed 15% of the revenue with an average ticket size of 2.6 times higher. Our white glove and yellow messenger services are being appreciated as one of a kind by our customers. We had more than 1.1 million calls to our customers, and they contributed 2% of our sales. Our endless aisle, with the help of these personal shoppers, now contribute to 31% of our omni-channel sales. I'll now move on to our strategic pillar of private brands. Our private brand volume grew by 38%, and overall sales grew by 11.5% versus a 10% decline in the overall company sales. This is the second consecutive quarter wherein we have registered volume growth. We have significantly improved our fashion quotient relevant to latest trends, besides upgrading the quality of our merchandise. We have also simplified the price matrix. Our customers are recognizing the improvements that have been made, offering great fashion, quality at affordable price points. We have launched Alt-Light athleisure for men and women, and the brand Incense in sleepwear and a number of products in the kids category. Our investments in private brand have now started to yield results. Our first citizen contribution to private brands is the same as the chain, indicating customer confidence in our private brands. Our private brand share in omni-channel continues to be higher than the overall business. Now moving on to our strategic pillar of beauty. Again, similar to private brands, our beauty business continued to remain strong and the beauty mix sustaining at circa 17%. Beauty category recovered to better than chain average growth in February and March, with makeovers being allowed from Feb until the middle of March. Our state-of-the-art luxury Arcelia store sales are ahead of the company, with average bill value higher by more than 70%. Our Arcelia private brand has continued to exceed budget and is now the second highest in sales value across Bath and Body brands. As I said before, the 2 Arcelia stores opened during the pre-COVID times have delivered the KPIs, and we are planning a mass rollout for the same this year and the next. I'll now talk briefly about the full year performance summary. For the full year of FY21, we have exceeded our internal target. Our chairman, Mr. Nagesh, in the first quarter had said that we will save 450 crores on cost. With the concerted efforts of the team, I'm happy to inform that we saved 433 crores versus last year, despite additional costs owing to 11 new stores that had opened in FY20. We continue to be debt-free, and there is continued focus on cash conservation across the company with cash and bank deposits. I'll now move on and talk about Q1 of FY22 and the way forward. We believe the COVID impact will continue for this quarter and the next. We have sufficient cash reserves to manage during these crises. The pandemic has tested the world in ways few anticipated. They also tested the resilience of our business, character of our people, agility of our operations, and the depth of our financial strength. While this has not been an easy year, it has made us a stronger business which is better prepared for the vagaries of the fast-changing world. Our people will always be our biggest asset, and ensuring the safety and well-being will always remain our topmost priority. At our company, we will start vaccinating all our employees. We are reasonably confident a majority of the employees would be vaccinated in the immediate future. We pride ourselves in operating a lean and cost-efficient business model. Our team delivered significant cost savings, which we are continuing forward. We continue to evaluate variabilizing cost structures and eliminating costs which do not offer much value to the customers to generate more fuel for growth. We will continue to invest in Omni, primarily in improving the customer experience. We have now begun the second phase of the upgrade of our Shopper Stop app with a complete redesign of the customer interface, analytics, and personalization. We believe we can now grow profitably in the near short term. While balancing cost and cash, we will continue to look for growth opportunities and invest in the right ROI model. This will enable us to grow the business and strengthen the same. We expect the COVID impact to reduce during Q2, and we are planning to open new stores as that happens. If all goes well, we should open 20 stores across all formats in this financial year. We have also identified some existing non-profitable stores which may further close 2 to 3 stores in the next quarter. This exercise will ensure that our chain continues to be more productive. Our safety measures for customers, employees, and all stakeholders will continue. Once again, I thank you for attending this call and wish you and your family to stay safe.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question will press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles.
Hi, can you hear me now?
Yes, sir, we can hear you.
So we have received around about 8 to 10 questions. What we thought, in the interest of time, both Venu and I will read out the questions and probably our reply, so that some of the questions would be automatically answered. Is that okay?
Sure, you can go ahead, please.
So I'll just read out the questions that have come to us, and either Karuna or me will answer based on the questions. So the first one that we had was breakup of exception items in Q4. Is that cross-word impairment only? What about the tax benefit on this impairment?
We will not get any tax benefit for the impairment, because an event has to happen to get the tax benefit. It's just a provision in our books, so we will not get any tax benefit. It's only cross-word, yeah. The impairment is only for the cross-word as well, yeah.
The second question is on the private brand mix as per the presentation on site in Q4 FY20 is 12%, and this quarter FY21 is 13%. So growth should be 100 basis points and not 250 basis points. So our growth on private brand is 250 basis points, and the reason it is that way is because last year the base or the denominator was only department store sales, whereas from this year it is on a company level, including home stock and e-commerce, which had not been included the last year, and also beauty. So if actually we were to look at the contribution of private brands purely on the same basis as last year, then the overall contribution would be even higher than what we have stated. Next one is on new store opening, 20 plus stores, which I have just stated again. Does this include beauty stores also, or is it only Shoppers Stop? This includes beauty as well. 10 Shoppers Stop stores and the balance of Celia store beauty is what we are planning to add. Next one is on what will the same store sales growth for Q4. Same stores like-for-like sales was a decline of minus 10.7%. Employee costs and other expenses have reduced by 13% year on year. Please explain what has changed. Karuna.
Thanks, Vinu. In the last 3 quarters, we did talk about 3 major factors. One, the employee cost optimization. That gave us a benefit in Q4 also. Second, our admin operating expenses, where we are very lean on that. And third, of course, part of the lease rental also helped us in the overall savings. So just to summarize, it's employee cost, our operating expenses, and the lease rentals.
The next one is on employee costs and other expenses. The question is employee costs and other sorry, we just took that. Sorry, my apologies. The next one is on COVID. Due to the second wave, when do you expect retail industry to return to normal in this financial year? We expect the impact to be for a finite period. As you all know, what's different between the first wave and the second wave, or last year and this year, is the availability of the vaccine and the aggressive vaccination drive that is happening. Given that on a daily basis the number of people getting vaccinated is on the rise, we expect that from the beginning of Q2 onwards, we should start to see a healthy recovery, and that will continue on beyond Q2 and on to Q3. I'll move to the next question. New store target for FY22 is 20 plus. Do you think this number is feasible as COVID cases remain elevated and lockdowns keep getting extended, delaying construction activities? Stores will be open subject to alignment on lease costs and capex with the developers. We will closely monitor and watch the situation, and we will open as the recovery of COVID happens. We do believe that there is a strong likelihood of us being able to achieve this number because a number of the stores, a majority of the 20 stores that we talked about are in various stages of development already. Moving on to the next question. 80% of our catalog is available on e-com. Do we expect this to touch 100% by Q1 FY22? What category of items are not available currently? Yes, we expect catalog to be at 90% plus of our store range. And there is a lot of work happening in the background to make sure that we are able to launch options online and in stores at the same time. None of our new category is missing incomplete. So where there are gaps, it's small portions of it rather than a whole category not being available. In addition, actually, even today we have 100 plus online exclusive brands, and we plan and expect to expand this even further, which means that our catalog on online will be significantly bigger than what we have in our stores. And this is something which we will continue to grow. Moving on to the next question. Cost saving for FY22, what area specifically? Will rentals be the majority driver for this? Karuna?
Again, Venu spoke in detail about the savings for last year as well as the investments, what we are planning for this year. If you are comparing the savings versus FY20, savings may accrue in employee cost, lease rentals, and operating expenses. It's a bit early right now because only 2 months have elapsed, and we are reasonably confident the stores will start operating from June or at best from July. Yeah, but the savings will happen in all the three heads. That is employee cost, lease, and operating expenses.
Those were the questions that we had received in advance. We can now move on to questions from the call itself.
Thank you very much. A reminder to the participants, anyone who wishes to ask a question may press star and 1 now. The first question is from the line of Nihal Jham from Edelweiss. Please go ahead.
Hi, good afternoon. Am I audible?
Yeah, you are audible, Nihal. Go ahead.
Thank you so much. Good afternoon, sir, and hope all of you all are doing safe. 2 questions from my side. In the last call, obviously, you did give a lot of granularity on, a tie-up with Amazon. If it's possible, just to give an update on some of those key parameters, how they are progressing, starting with the number of stores that are onboarded and also on the SKUs and delivery time. I'll move on to my next question after.
You said 2 questions. Do you want to wait for the second one? Or do you want to give it up?
I'll wait for the second one after the Amazon question.
Okay. So the question I assume, the line was not fully clear, but I understood it's about the tie-up with Amazon and how's that progressing.
Yes.
Yeah? So it's progressing well. We have 50 stores which are now tied up with Amazon, and we have now got a consistent level of business from Amazon. About 20% of our online sales comes through that channel. Further, we are consistently achieving the 99% CPT that is expected to be achieved. And that is something we are extremely proud of, because the target of achieving a 99% CPT for orders received within 24 hours is quite tough. And I'm proud to say that the team has done a fantastic job of managing this and making it happen consistently over the last 2 quarters ever since we went live on Amazon. In terms of the number of options, all the options that are available on shopperstop.com, on in stores, is also available on Amazon.
Sure. And if I may, what would be the number of SKUs approximately that we have on the Amazon website?
See, the number of SKUs, I don't want to give a number purely because it would vary depending on the time of the season. Because as you know, we are aiming and we are moving towards monthly launches, and we've got newness coming into stores all the time. And as that happens, the number of SKUs does vary. Our aim is that all the options which are available in the store, we would aim to have all of that available on Amazon also, so that any customer visiting Amazon gets the full breadth of what we have in our stores. There would be probably a few exceptions where a brand may not want to be on Amazon, and those are the only ones which would not be there. But other than that, everything is there.
That's one follow-up on that. As we noticed that in the last 2 quarters, the number of stores that we have tied up on Amazon are 50. Is it that the other 30, 35 stores are still work in progress, or those are not stores that we plan to onboard to the Amazon website?
So the way we have chosen the stores is to cater to the cities that we are in. So adding multiple stores in the same city does not necessarily give any incremental benefit. The whole purpose of adding stores onto Amazon is so that we are able to cater to a city. And that is the reason that we have chosen 50. As you know, we are in 40 plus cities that we are in presented. And hence the 50 stores that we have effectively caters to pretty much every city that we are present in.
That's helpful. So just one last question from my side. On the private label side, it is commendable that we've seen the increase in our share. One thing that you've consistently highlighted is in terms of launching new collection, which looks priced more towards the value side. Other than this, are there any more initiatives that you want to highlight on what has been done in the private label over the last year?
There are a number of other initiatives which we are working on, and we will share with you on those in the coming quarters as we roll them out. All that I would like to, and what I can say for sure, is that this is a big area of focus for us. It is one of our key strategic pillars, as we have consistently mentioned over the last few quarters, and there is a lot of work happening in the area to grow it as we move forward. I already talked about launching athleisure and incense. Athleisure for men's and women's, and incense for sleepwear. We have also, to enable the monthly launches that we are moving towards, we have tied up with a UK-based design house specifically for the women's western wear range, and that is helping us tremendously to sharpen our range and also bring in the latest fashion trends into our stores at the same time as the rest of the world. There are a few other initiatives which are in progress, and we will share that in the coming quarters.
Sure, that's very helpful, sir. I'll come back in the queue for further questions. Wish you all the best.
Thank you, Nihal.
Thank you. The next question is from the line of Kaustubh Pawaskar from Sharekhan by BNP Paribas. Please go ahead.
Yeah, thanks for giving me the opportunity. I just have one question on the private label. So what is the repeat purchases on at your private label brands?
Sorry, what is the question, Kaustubh? What is the
repeat purchases? Like, for example, you said that First Citizen members are there, or what is the repeat purchases or repeat sales on private label brands?
Kaustubh, I might not have the exact number to hand, but if I were to draw, our First Citizen customers, and majority of our sales comes through the First Citizen customers, as you're aware. Within our First Citizen customers for the quarter, 60% of our sales came through repeat purchase from First Citizen customers. And we also know that the private label performance, or the contribution of private label from First Citizen, is pretty much the same as the rest of the business, with online being actually slightly higher. So I would suspect that private brand repeat purchase would be upwards of 60%.
Okay, that's helpful. Sir, on cost saving side, you mentioned that what would be your key focus areas. In FY21 there was saving of more than 430 crores. This year, any particular target you have in mind, or time will tell that how you are planning for the
Hey, Kaustubh, I think you have the answer in your question. We have already saved 433 crores versus FY20. And we will see how FY22 pans out. And we will also explore whether any further savings within FY21 is possible or not. In fact, Venu in his speech has already said that we are variabilizing every cost so that whenever the sale comes down, we have the ability to cut down the cost. To answer that question, 433 has been already done. Anything higher than that would be difficult, but we are still exploring that.
Right. And so one last one, that disruption is more towards closure of these stores. But anything on consumer psyche, whether because that gives you a confidence that you're saying that you are seeing a good sharp recovery from 22. So anything from consumer psyche or mindset point of view, that whether they would be definitely looking at purchasing once the stores are open, or something on that front, basically from demand side.
I'll let me try and answer that, Kaustubh. So if we go back to the first wave which we had last year, and then as stores started to open, what we had seen that while online continued to stay strong, the footfall into the stores also continued to grow month on month, getting up to what we had shared Q4, we got to 83% of the previous year. And what we did see was that every single month there was growth over the corresponding month in the previous year. So that gives us a bit of an indication in terms of how consumers behave once the economy opens up. We have also got indications coming in from the Western world where the second wave happened a little earlier than what it has happened in India, and we see reports of strong sales and footfalls coming back into stores. However, what we do also see is that there is change in consumer behavior, and we expect to see that. We are already seeing that. There is move towards more casual wear, more athleisure, fitness, home, and these are categories where we have also pivoted towards. So, and going back to first principles, we cater to our customers' needs, and we aim to stay ahead of what our customers are looking for. And that's the way we would continue to move. And hence, we believe as the impact of the COVID keeps coming down, footfalls into stores will recover, even as online continues to grow. And our physical presence combined with online puts us in a pivotal position to be a true omni-channel retailer, which is where we are moving towards.
Thank you, sir. That was really helpful. Thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and one now. The next question is from the line of Binoy Jariwala from Sunidhi Securities and Finance Limited. Please go ahead.
Hi, Karuna and Venu. Thank you for the opportunity to ask you some questions. So this first question is on the cost savings program. We've done about 433 crores. And we've maintained in the past that about 200 crores would be sustainable. Is there any change to that? And within the cost savings program, is it possible to split how much came from lease rentals?
Almost slightly less than 1/3 came from lease rentals, and the 2/3 came from salary and other operating cost demand. And as we said last time, 200 crores will be sustained. we don't foresee any issues on that. On an LTL, on a like-to-like basis, we will definitely save 200 crores.
Right. And relating to this, you've also said that some of this cost savings would be plowed back into the business. So were you indicating, just a clarification, that were you indicating plowing back into the business in terms of capex, or would it be in terms of some additional opex?
It will be primarily in OpEx. There are two areas where we are focusing. One, our Omni, particularly the tech cost and the overall the other cost in operating Omni. So we are planning to invest a sizable sum on that. We are still working on that. And second one on marketing. Last year, if you have seen, our marketing was significantly lower. But as we expand both offline and online and the Omni, we need to spend some amount on the in marketing. So those are the two investments we were talking about.
Fair enough. My next question is on the, in one of the calls, I think Q1 or Q2 call, you said that the break-even level of sales for us on an annualized basis is roughly about 3,700 crores ballpark. Now, just wanted to understand how are we looking at this level of break-even sales, which seems to be quite high, and is there any steps to further lower this threshold that we need to achieve just to break even at a PBT level?
The amount may not be 3,600, it may be slightly lower than that amount. But given the fact the fixed cost, what we have on the margins, what we earn, it will be more or less close to that range. It will be definitely lower than 3,600. We are working towards it, but it will not be significantly lower, Binoy.
Yeah, and related to this, two main line items. Should I consider once we hit the steady business, our gross margin should be roughly about 32 or 33 odd %. Is that the steady state gross margin? And the second point, just a clarification that this time, and these are the non-GAAP numbers that I'm talking of. This time, our depreciation was roughly about 35 odd crores, seems to be lower. So is that the steady state depreciation per quarter that I should be looking at going forward?
Yeah, to answer the second question, the depreciation will be anywhere between 30 to 35 crores per quarter way forward, unless we have significant number of new stores. Then obviously the depreciation will go up. But on a present state, it will be anywhere between 30 to 35 crores, Binoy. And your gross margin is more or less right. Probably if the private brand mix goes up, the margins will be slightly higher than 33%.
Understood. Now my last question is on our capex plan. One is that we've done a capex of roughly about 82 crores in FY21. Just if you could highlight which are the areas in which we incurred this capex for FY21, because when I look at this, the retail area addition, it's roughly about flattish on a YOY basis, and the store count is down. So maybe we've added and we've closed some stores, and there could be some capex on omni-channel. So if you could just help me with that. And the second part on the capex was specifically for Venu, coming to FY22, we're looking to add about 20 stores, 10 which is Shopper Stop and 10 odd in RCR format. Now, in the past, you've indicated our move towards the smaller size stores, that's 20-30,000 square feet odd size stores. So the Shopper Stop, these 10 stores would be the smaller format stores. And second is that these stores addition, now are we looking to balance our portfolio mix a little bit more in terms of split between malls and standalone stores? Because right now it's heavily tilted towards the malls.
Hey, Vinay, what I will do, I will answer the first question and Venu will take the second one. On the total capex spent, we spent around about 57 crores, not 80 on crores. I mean, if you have that number, we can talk offline and we can reconcile that number. But as per us, we have spent 57 crores on capex. See, we did open one new store in Lucknow last year, sometime in June or July. So primarily we spent around about 1/4 of the amount of that. The balance amount is primarily on the e-com. As I said, some of the capex we maintain on e-com and IT because we also capitalized S4 last year in the month of June. So these are the two large items we spent on the capex.
Vinay, on the store portfolio, you're absolutely right, and that we have tightened, standardized the store sizes, and our average store size has come down. It is circa between 25 to 30,000 square feet that we look at. And also the ones that we are going into, predominantly we are going into newer cities where we are not present, which helps to expand our reach, and that is one major criteria. And finally, also we are looking for greater partnership and participation from our landlords or developers to help us with the overall investment. And as we do that, obviously what we are able to do is to increase our reach and get into parts of the country where we are not present, even as it is a much more efficient model that we go with.
Sure. So anything on the malls and standalone stores, will the new stores be mall, standalone stores? How should I think of that?
We go into a combination of standalone and malls. And the first principle is about having a location which is right for the customer, where the customer is available. So we are not hard and fast that we would do only malls or we would do only standalones. The location is what drives that decision.
Vinay, if you don't mind, there are others in the queue and we have stop at 1 o'clock. I hope you don't mind.
Yes, sure. Thanks so much. Yes.
Thank you.
Yeah.
Hi, Ankit, go ahead.
The next question is from the line of Ankit Kedia from Phillip Capital. Please go ahead.
So my first question is on revenue recovery. This quarter we have seen non-metros actually post a positive growth compared to metros. Now with COVID cases more in non-metros compared to metros, and probably malls, municipalities and cities might open malls slightly later compared to standalone stores. What happened in wave 1? What gives us confidence that from Q2 onwards we could see a full recovery in revenues? Apart from the vaccination drive. Hello.
Sorry, Ankit, if I understood right, your question is around the non-metro versus metro?
No, Ankit is asking us what is our confidence level which will ensure that the sales will grow in non-metros as it was last year, considering the number of COVID cases higher in non-metros versus metros.
Okay, I mean, it's obviously the recovery does get linked very closely with the level of COVID cases, and that's something which we have found. As I said earlier, the fact that there is a vaccination drive and an overdrive that is happening, that definitely helps. The second factor, I think, also what we should look for is the fact that our locations and whether it is a standalone or a mall, we are in large spaces with safety being right at the forefront in terms of the protocol that we follow. And because of that protocol that we do, we offer a location or an environment where customers would feel safer to come out and shop with us compared to going into a market or a regular marketplace. And that's something which we saw happen in the last quarters, and that's something which we expect will continue. And hence, people would prefer to come to us compared to going into other places.
And sir, by when do you think we can get a complete revenue recovery compared to FY20 this year, or it will be next year only?
We expect the recovery to start from, I would say, early Q2 onwards and progressively improving into Q3 and Q4. This time, Diwali and Dussehra are earlier than last year, and that should also help for that curve to pass in.
Sure. So my second question is regarding Omni break-even. At what revenue run rate do you think Omni can contribute positively to the EBITDA margin? Given that now it would be break-even or marginal losses, given that you have spoken about tech cost and marketing spends on Omni as well.
I think, Ankit, in a way, the answer lies in your question itself. When we talk of omni-channel business, it is truly omni, as in a combination of online and offline. It is not a multi-channel, and I'm drawing a distinction here between omni and offline. The reason I say that is because increasingly the journey of the customer could start offline and close online, or the other way around, and could be a multiple combinations of those. And hence, we as a business would not look at it separately, because it's become increasingly harder to attribute as to where that sale came from. And I'll give a simple example of Endless Aisle, where a customer has actually browsed our website, put an item in the cart, and then chose to come to the store and buy it. Now, it would be very hard to classify it as offline and online, and that's the reason we would not separate it out when we look at profitability as an omni sales versus a store sales. It would be one business.
So that being the case, then has the cost of retailing gone up because we are spending more to give the customer, get a 360-degree view of the customer and be more personalized for the same wallet share? So in the long run, even if we assume 10% could be the online omni contribution, if I use that word, and the customer acquisition cost or migration cost of the customer being higher, so it will be more difficult for us to make the same EBITDA margins from the same customer?
I think the assumption there that the cost would be higher is not necessarily true, because your repeat cost would be much lower. And also, you would save on, you wouldn't have a lease cost if you don't have a store. So it's not a direct comparison there. And hence, when you are truly omni-channel, you get the benefits of both offline and online. And that is where Shoppers Stop benefits significantly, because of the presence of physical stores combined with online, which means that our ability to serve our customer and reach our customer much faster from the physical store, as also do it at a much lower cost, because of the fact that it is the same inventory which we are sharing across both online and offline. And that's a significant point. The fact that all our 87 Shoppers Stop stores and the 100 plus beauty stores are all linked to online, and the inventory from all of these stores is available for our customers to shop from, means that we are making use of our inventory much more effectively. The sale becomes very fungible because of that, and that's why it won't be right to say that the cost is higher when you do through the digital channels.
Sure. And Karuna sir, just one last question on the balance sheet.
I'm really sorry, but I see a fairly long list of people who are still waiting to ask questions. So if I could,
I'll take it offline with Karuna sir.
Happy to answer them separately.
Yeah. Probably we will extend 1 or 2 minutes yet. So Ankit, if there's any case, we will do that. Thanks. Go ahead, Anurag.
The next question is from the line of Anurag Jain from GLM Capital. Please go ahead.
Yeah, this is GLM Capital. Okay, am I audible?
Your voice is not clear, Anurag. Can you come closer to the mic?
Yeah, is it better now?
Yeah, better.
Yeah. Thanks so much for the opportunity. So my question is maybe a little less optimistic. So wanted to understand that while Q4 was good and we were EBITDA positive, Q1 may not be the case. So my question is, in terms of cash burn, how long can we sustain whatever cash burn we are having currently? And if this, this COVID continues, in terms of capex that we are planning this year, would we be able to fund it internally with the cash balance that we have, or we would come back to the market or borrow? Any thoughts on these lines would be very helpful.
Yeah, Anurag, all your questions were answered by Venu in his opening speech. If you said, to answer your question, the first question, the cash burn, but we are assuming that the COVID will continue forever. It will not. We have seen Gujarat opening day before yesterday. Madhya Pradesh said they will start from 1st of June. We have been hearing rumors about Delhi. So, we do expect the recovery to start as quickly as possible. We did mention about the vaccination drive that the government has already taken. So, it's sort of a very, very hypothetical question, right? What happens if COVID continues for a long time?
In that case,
let me complete the question and then I'll go one by one. Okay. Second, you also asked about the capex. Again, when you said, right, if all goes well, then we will start increasing the capex. Obviously, if the COVID continues, our capex plan will also be deferred.
Got that.
Yeah.
And as I said in my remarks, Anurag, conserving cash is obviously the number one objective and focus at this point in time. And we will keep reviewing that based on how the COVID progresses.
Got that. So we would not need to come to the market. That's the only question, bottom line here. Or would we?
As of now, we don't have any such plans, Anurag.
Perfect. That's all. Thank you so much. That's all.
Thank you.
Thank you. The next question is from the line of Devika Singh from Money Control. Please go ahead.
Hello.
Yeah, Devika.
Hi, Mr. Nair. Hi, Mr. Mohan Sundaram.
Hello.
Yeah. I'm audible, right?
Yeah, quite clear. Go ahead.
Okay. So my questions are mostly around your online exclusive private brands. So you shared that you have 100 plus online exclusive private brands, right? I'm correct on that number.
Yeah.
Okay. So I wanted to understand which are the main categories in which these, private brands have been launched. And going ahead, how many more private brands are you going to launch? Maybe let's say in the next quarter or.
Sorry, I think you're talking, when we said we have over 100 brands which are online exclusive, what I meant to say is that these are available only online and not offline.
Okay.
So they are exclusive to online for Shoppers Stop.
Okay. So these are not all private brands is what you mean. Some of these are private brands. It's a mix of private brands as well as other brands.
No. Sorry, sorry if I gave you the wrong impression. That's not what I meant. What I meant was we have over 100 plus brands which are exclusively available on Shoppers Stop online but not in the Shoppers Stop stores. So,
yeah.
And that was specifically answering the question of the number of options that are available online and the highlighting the fact that we have a much wider choice available to our customers online compared to the store.
Okay. But then are these your private brands or are these brands that you've tied up with other manufacturers and launched? Are these are private brands, right, that we're talking about, that just available online on your store?
It would be a combination of various brands.
Okay. And which are the categories where which is the focus when it comes to these brands online, which are available exclusively?
It's across all the categories that we retail, Devika.
Okay. So also, given the second question, given that almost for 2 months now, this quarter for 2 months almost your sales have suffered due to lockdowns. I'm talking about the first quarter of FY22. How much of a hit are you expecting for this quarter going ahead?
Sorry, I lost you. After 2 months of lockdown, what did you say, Devika?
I'm saying that given that for almost 2 months now your sales have suffered in the first quarter, right? So I'm trying to understand how much of a hit are you expecting for this quarter?
You mean the
first quarter FY20?
I think you know that we normally don't give any guidelines, Devika. All I can tell you is that it will be better than last year. I mean, that's the only thing we can say that right now. But we don't normally give any guidance because it all depends on how June is going to be and how much stores are going to be. Because we don't have any control on that right now. So let's wait for June and then probably we can see our numbers.
Okay, sir. Thank you. That's all from me.
Thanks, Devika.
Thank you. The next question is from the line of Gaurav Jogani from Axis Capital. Please go ahead.
Thank you, sir. Sir, my question is with regards to the previous question only. I mean, what are the main categories, that you're seeing main traction on the online channel? I mean, while your mix could be different on the offline, how different is it on the online channel, and which categories are seeing more traction?
So, primarily, the category performance online mirrors what we see offline. Of course, there are variations, and I will take that back to another point which I had mentioned in my earlier talk. We see that our average bill values are significantly higher than what pure online companies see, and a reflection of, one of the reasons for that is because of the high trust that customers have on Shoppers Stop. And because of that, brands which have higher unit values, we find customers prefer to shop with us because of the fact that they can trust the authenticity of the brand that they are buying, because of the fact that there is also the convenience of being able to go into a physical store and either check the product before they buy, or even after sales in terms of if there are any issues, etc., they feel a lot more comfortable buying with us. So we do see that higher value products, customers tend to prefer us compared to a number of the other brands. In terms of specific categories, the overall mix tends to be very similar to what we see in our stores.
Sure. Also, the reason why I asked this question is just to gauge, because you said the basket size is higher. So are you also seeing, the products which are primarily high gross margin, like beauty or maybe private brands having higher traction there, and definitely taking the margin profile higher in the omnichannel?
Binay, unfortunately, we could not hear you clearly. Binay, can you just...
It's not Binay.
Gaurav.
Yeah. So what I was asking was that because of the higher basket value that we are having on the online channel, and maybe the share of the beauty in the private brands would be higher because of that. So is the gross margin then higher in the online channel?
So if I rephrase your question or just repeat your question, what you are saying is the gross margin higher online than offline? Is that what you're asking?
Yes, sir. Yes.
So I'll again go back to what I said to answering a different question, Gaurav. When we are looking at omnichannel business, it won't be right to classify sales specifically to one channel and look at margins specifically for one channel, because the customer journey begins online, finishes offline, or vice versa, or a combination of both channels, and hence we don't necessarily look at it specifically that way.
Okay, sure, sir. Got it. And sir, my last question is with regards to the CapEx that we are looking for this particular year, assuming that we go ahead with the plans of 20 stores that we are having right now. And that will be the final question for me.
Sorry, Gaurav, again we are not hearing a word what you said. Sorry. Your voice.
Sorry. So I will repeat it again. So I was asking about the capex that we are envisaging, barring that we are doing 20 plus stores this particular year.
Yeah, Gaurav, I mean, if all goes well, we should incur the capex for all those 20 stores, plus we also have some investments in IT as well as in e-com. So all those things will happen, but as Venu rightly said, if all goes well, yeah, the capex will be there. We are expecting anywhere in the range of 80 to 100 crores. But let's see how the economy progresses, and we will invest that.
Sure, sir. Thank you. That's it from me.
So, Gaurav, what we want to do, Gaurav, there are a couple of more guys in the queue. Can we just complete? In fact, Ankit, if he's still there, he had a question. So why can't we complete all the three before we end the
Sure, sir. We can do that. Yeah, we have to start.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and one now. The next question is from the line of Binoy Jariwala from Sunidhi Securities and Finance Limited. Please go ahead.
Hi, thank you for the follow-up opportunity. My question is on inventory provisioning. Did we need to provision anything in quarter 4?
You mean last quarter 4 you're talking about?
I mean quarter 4 FY21. Did we need to provision any inventory?
Yeah, we did. So, Binoy, as a policy, we have an inventory provisioning policy, and based on the policy, we keep providing every quarter, depending upon the age of the inventory.
Okay, but there was no accelerated provision required, maybe due to business conditions or anything like that, right? This is just the ongoing provisioning that keeps on happening every year.
Absolutely right. See, do remember that almost 70% of the inventory is on returnable basis. So the question of making a provision on the returnable inventory doesn't arise at all.
Right. The second question, my last one, is on the store addition plan that we said. So this 80 to 100 crores that we are saying, if all goes well, would be funded from internal cash accruals, right?
Yeah.
Okay. Thank you so much. Yeah.
Just to give you another one, Binoy, I mean, on the inventory, if you have seen, the overall inventory has significantly reduced compared to the last inventory.
Right.
The outright inventory, we have reduced more than 200 crores in the last 1 year.
Right. But is this also a function that now we will be operating stores with a much lower inventory? Should I also look into it like this?
Yes, absolutely. So a big part of what we did across, the planning for that had happened in Q3 and it was executed in Q4, was to relook and rationalize the offering that we have in stores. And as a part of that, we have actually brought down the level of inventory in our stores by as much as 25 to 30%. And you would see that if you go into our stores as and when they start to open, the level of inventory has come down, and with the sole purpose of making the customer journey a lot more smooth and shoppable. Also having more turns in terms of getting newness into the store more often, and that way every time a customer walks into the store, they are more than likely to find something fresh, something new, something different, and that's what encourages and drives repeat purchase. So that's what we've been doing. So fundamentally we've brought inventory down significantly in the last quarter, and we continue to monitor and maintain that as we go forward.
Sure, that's really nice to hear. And sorry, my last question, if I may be allowed, this is on, in the previous con call we said that we are looking at hitting FY19 sales run rate by quarter 2 or quarter 3 of FY22. Do we still maintain, let's say ballpark quarter 3 should be a good enough quarter to achieve FY19 sales run rate?
I guess at this point in time, that would be a bit difficult to predict going forward because that would also depend on when the recovery begins to start. As I said, we expect the recovery to start sometime in Q2, but the trajectory of that is something which we would like to wait and watch before we comment on that.
Fair enough. Thank you so much. Thank you.
Thanks.
Thank you. The next question is from the line of Ankit Kedia from Phillip Capital. Please go ahead.
Sir, couple of questions. My first question was on the private label business. A very healthy volume growth of 30% plus, while the revenue growth was, slightly lower than that. So one, is it due to liquidation wherein we had a EOSS in Jan, Feb, so there were deep discounting which drive volume, or structurally in the system we have taken a sharp price correction for the private label business, and now structurally the focus would be on sub 1,000-1,200 crore price points, which will drive volumes for the private label.
So the question, Ankit, again, the line was not very clear. So I'm just to make sure that I've got your question right. Your question was on the growth in volume has happened because of discounting or because of sharpening of prices is your question, right?
Right.
Okay, fair. So Q4 specifically, Q4 was, as you know, a combination of the end of season sale period, which was in January, and some couple of weeks in February, and then the rest of it was the new season, which was the launch of Spring Summer 21 that had happened. So Q4 specifically, obviously, it was a combination of discounted merchandise during the end of season sale and fresh merchandise in the post end of season sale in February and March. What we are very confident and delighted with is the growth that we have seen in the fresh merchandise when we launched the new season. And that has happened by a sharpening of the price points. The fact that we had a 34% growth in volume, and that just signifies the fact that we are, and bulk of that, I mean, it was predominantly that level of growth in volume was maintained, and if anything accelerated into March, when it was all full price merchandise that we were pretty much trading, and that has happened because of the sharpening of the prices. And by the sharpening of the prices, we are able to sell a lot more, which means that our customers are blessing us with their business and buying a lot more from us.
That's helpful. So my last question is on Crossword. Are the bulk of the store closures in Crossword behind us now? What is the longer term roadmap for Crossword as a business for Shoppers Stop?
We are evaluating Ankit on Crossword. So just to specifically answer the question, I mean, we have closed more than 15 odd stores last year, and the cost has significantly come down. In fact, we have reduced the cost more than 60%, and these savings are completely sustainable. So we do expect Crossword to break even probably if all goes well this year or at least next year. We should be well in Crossword, Ankit.
And so from the home shop perspective, now with home as a category, this year has seen a sharp growth. All our loss-making stores were closed a couple of years back. Now with 11 stores with us, from that perspective, do you see a long-term business growth coming in from there, or we are happy with the 11 store network and that will continue? Or in us, Shoppers Stop itself, we are creating a small space for the home section, and that will be the growth trajectory for the home stop.
Home as a category, Ankit, has seen a significant growth over the last 2 quarters, and this is something which we are quite pleased with. It is a healthy EBITDA business for us and will continue to remain a focus area. We have the 11 home stop stores, which are the larger standalone formats, but even as we go forward, the primary aim will be to have a large home section within the existing Shoppers Stop stores, so that we are offering our customers end-to-end offering across the multiple categories that we trade in.
Thank you so much, sir, for all the questions. Stay safe.
Thanks a lot, Ankit. Gaurav, can we end the meeting if you don't mind?
Sure, sir. Sir, if you'd just like to give some closing comments, and then we can close the call.
Sure. So, firstly, thanks to everyone for all of those who attended and who logged in. Appreciate you spending the time with us, and we hope that we've been able to answer the questions. Overall, as I said, for the full year, we exceeded our internal targets. We had set aggressive cost reduction plan at the beginning of the year, and we are delighted that we have broadly achieved all of that. We as a company continue to be debt-free, and in the short term, the focus will continue to be on cash conservation across the company with both our cash and bank deposits. And finally, our omni-channel business and the growth that we have seen on that is something which is propelling us towards being a truly omni-channel retailer. The combination of the physical stores that we have, along with the significant progress that we are making through our digital channels, enables us to be able to reach our customers through the choice that they make in terms of how they would like to interact with us. We have a strong business in terms of the loyal customer base that we have, great product offering, we are a house of brands, and combined with the ability for our customers to shop with us across multiple channels, makes us a very strong business going forward. Thank you very much.
Thanks a lot, Gaurav. Thanks for hosting it. Thank you.
Thank you. On behalf of Axis Capital Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.